tax avoidance is totally different from tax evasion. You know, if you're an employee and you're paid $70,000 or $80,000 a year, and then you can go be a freelancer and make 150, you think you just doubled your income, but you didn't. All of this is predicated on good cash flow management. So if you're making 150 a year, that money is coming in. You've got to have a plan for it of where it's going, and every dollar needs a job. I think we should each focus on what we do best to make money. So if you're really good at content creation, fantastic. Hire this stuff out to a professional. My general rule of thumb is if you're making less than 250 a year, you should be taking home at least half of that, at least. Probably more, probably 60 to 65%. And you get to run your business on the rest. But as a rule, you got into business to be profitable. Don't steal from yourself. Entrepreneurs are so bad about that. And the cycle doesn't end either. So that's why I highly recommend get disciplined with your cash flow and then stick to it. So your business can't thrive if your finances are a mystery.
All right, guys, welcome back to the Video Income Secrets podcast. In today's episode is going to be special because, guys, we've been talking about making money, scaling your businesses. But there's a question that says, actually, let's say you make all the money, all the good stuff, but what do you do with the money? How do you manage your money? How do you future-proof your money? How do you save money on taxes? Because I know every year we kind of have to pay taxes. If you I live in Canada, but some people live in the US. And I mean, even if you live in Europe, anywhere in the world, you kind of have to pay taxes, right? So all that part may not kind of sound very sexy, but at the end of the day, it doesn't matter how much money you make. What matters the most is how much money you actually keep in your pocket. So today's guest is going to be talking to us about financial planning, saving money on taxes, and some other cool stuff that will help you actually keep the most from the money you're actually making, right? So I'm not going to take much time. I'm going to bring in my brother, Nick. Nick, how you doing, man?
I'm doing so well. It's good to see you, Sam. How are you?
Oh, man, I'm doing fantastic, man. I appreciate you being here, and I'm super excited about this episode. So can you just give us an idea, like, are you even doing videography? Because most of my audience actually are videographers and photographers, creatives in general. Have you done photography or videography before?
Yeah, so the extent of my videography now is usually just creating my finance shorts for social media, but I've done a lot of photography in the past, especially, and really enjoyed doing just different types of photography work. What I love about photography is you capture a moment in a still that you can look at forever, and it isolates that one moment of time in a way that just a memory or even a video just doesn't quite capture, and being able to tell a story through capturing those beautiful moments. I'm thinking right now of pictures I took of my kids last summer playing outside and just how special those moments are. So yeah, I mean, you can see my love for the romance of photography. But yeah, so I've done photography work, a little bit of video here and there, but now I've kind of shifted into a different career direction.
Yeah, which is exactly what we're going to be talking about today. So now you are in financial planning and things like that. Can you just give us an idea, just a short introduction for most of us who don't know about you before we actually get started?
Yeah, so I'll start with, I know this might seem like a bit of a weird fit, right? Finance on a video content podcast. But I work with some creatives, and I've worked with a lot of creatives in my life. And, you start with a passion, and then you sometimes hit a wall when money gets complicated. And even things like LLC registration or opening your business and getting the bookkeeping set up and working with an accountant, or it's tax time and you feel very disorganized. It's very, very stressful. So I'm here to make it simpler so that you can do what you do best, right? Creating great content and making beautiful work in the world without losing sleep over things like taxes and cash flow and where your business is going to be in a few years and whether you'll ever be able to retire and live the life that you want to live and get that time freedom back that we all crave as entrepreneurs, right? So I come from a background, even when I was doing photography, that was never my full-time thing. It was mainly a hobby on the side. So I've got a background in finance and data analytics. I did reporting and dashboarding for a company for a lot of years, making cool visuals and those kind of executive dashboards that you see people talk about where you can kind of click and stuff. But I basically functioned as like a small business, sort of like a CFO, basically, where I was just overseeing all of the financial operations and monitoring the business efficiency for our small family business. Then we were acquired, and I did it for a few more businesses. And then I left that last year to go full-time in personal financial planning for business owners. So my goal, like I said, is to make all that process simpler and less painful while helping to future-proof you and your business and your long-term planning.
That is awesome, man. So yeah, I'm excited about today's episode because yeah, I know we're not gonna be talking about, things like how to make more money. Actually, we're gonna be talking about more about how to keep your money. Like, because once you make the money, the government is waiting for
That's
it's,
right.
it's actually waiting for you to, to kind of start paying taxes and things like that. You also have other bills you kind of have to take care of. You have some people have investments. Maybe some people are investing in real estate. I do like to invest in real estate personally. So let's start with taxes, right?
Okay.
How should creatives behave like when it comes to taxes? What are the legal ways to actually save money and avoid? Obviously, you can't avoid paying taxes, but at least take advantage of some of the programs out there to save money in that regards.
Well, so I would actually clarify something there. Tax avoidance is totally different from tax evasion, right? Evasion will get you in prison, but avoidance, that's just prudent tax planning. Obviously, I'm not going to speak to some of the specifics since the audience is all over the place, but there are, especially if you're in the US, there are things like qualified retirement plans, simple business deductions, qualified and ordinary use of your money in the normal operations of your business that you deduct then from your income that are non-taxable, right? So, I mean, the simple example is if you make $1,000 and you spend 500 on equipment, obviously you're paying taxes then on the 500, not on the full 1,000. But there are a huge variety of normal business uses for your money that may or may not come with personal benefits. A couple ideas I like to talk about are if you have kids that are old enough, usually around age 10, you can actually hire your kids, write a job description for them, interview them like you would an employee, make it feel official, but give them a real job to do, real responsibilities, like whether it's cleaning equipment or cleaning your office or organizing papers or sharpening your pen, whatever it is, give them something that's an age-appropriate job description. By the way, ChatGPT is a phenomenal tool for creating a great job description for a 10-year-old if you need some advice there. Really great. You can throw some prompts in there and get some ideas. But save that down, hire your kid, pay them. And when you pay them, the wages are deductible to you because it's a wage. It's a normal business expense. The money goes to your child up to the single filer standard deduction, which I think this year is 15,000. 15,000 is a ton of money to pay a 10-year-old, by the way. But I mean, even if you pay them 3,000, it's all deductible to them if this is executed properly. And then they can put that money straight into a Roth IRA, which I know I'm speaking to Canadian, but that money then won't ever be taxed. So it's a really cool triple tax benefit. That's one example. Another one might be instituting a personal retirement plan. If you're a freelancer, you may be thinking like, I can't afford that. I can't do that. It's too complicated, 401ks, whatever. There are simple plans that are very affordable, very low cost. In fact, it may even just cost as little as having your tax preparer file an extra form. And then you open the account and you can defer money into that account. You can put money in the account, not pay tax on it now, and then pay tax on it later when it comes out. Things like a solo 401k or a SEP IRA, even just a personal IRA. These are great vehicles for solopreneurs, freelancers, 1099 self-employment income to save now on taxes, defer them until later, and save for your future as well.
So what's the first step like to get to do those things?
Yeah,
obviously you're gonna need an accountant.
totally, because that's like step 4,
Like,
right?
what's the first step? What, like, I'm making money right now. I'm making, let's say, I don't know, 100,000 a year or 150,000 a year from my creative gigs here and there. Like, what's the first step? Should I even register my business, or can I just operate as a solopreneur under my personal name? Like, what are the steps?
That one depends. You should talk to an attorney. Because that one is a question of risk. What's the risk if you don't register? An LLC or a business entity is designed to contain risk so that if something happens within the business, your personal assets and your personal life are separate, right? So that if you get sued, if there's some big problem or liability, the insurance that you have here within the business entity will cover it and it won't spread out to the rest of your life. So whether or not you need to contain risk is a great question for an attorney. And usually, that's kind of like one of those free consultation meetings. If you find a business attorney in your area, you set up a 30-minute session to talk with them, or even your tax preparer. If you don't have a tax preparer and you just do it all yourself, I highly recommend you try for a year hiring a CPA or an EA, or I think they're called PAs in Canada, just professional accountant. But hire someone to do your taxes and to do a full audit of how you're running your business, and bring in a professional just to make sure you're not missing anything major. If it proves, that you think, hey, I could totally do this on my own, go for it. That's fine. But bring in an outside voice there. So anyway, but to your question of the first step, all of this is predicated on good cash flow management. So if you're making $150,000 a year, that money is coming in. You've got to have a plan for it, of where it's going, and every dollar needs a job, as my favorite budgeting expert likes to say. And so every business owner needs basically a five category budget for the money. So the first dollars that come in, I actually recommend allocating that money first to profit. But you have to kind of back into that number. That comes from a really great book called Profit First by a guy named Mike Michalowicz that outlines the system I'm about to explain. But basically, you give money to profits, then owner's compensation, which is your actual pay. Those are different. Then taxes, operating expenses, and emergency savings. So every dollar, you're going to put maybe 10 cents to profit, 20 cents to owner's compensation, 15 cents to taxes, and the rest split between emergency and operating expenses. And what you're doing is you're limiting the operations of your business down to what an industry standard reasonable amount of an operating margin would be for your industry, which, for video production or for freelancing, it might be 30%, it could be 60%, it depends kind of on your business. But by limiting it right as the money comes in, you're removing the temptation to spend all your money on growing the business, which is such a tendency, especially when you're trying to grow, when you're trying to build. You think, oh, well, I always have to spend more to grow, and that's not always the case. Profits are the way your business takes care of you, and when you're profitable and when you're paying yourself, now you can start to future proof, as you're describing, where you can start to take your personal income. That's if you're making 150 and you're keeping 90, the 90,000 now you need to plan for your family. Okay, well, this much is going to go to housing and utilities and wants and needs and long-term savings. Then we're going to give some away. And so, once you have that kind of 5 core category plan with your business, you can then move to creating a personal cash flow plan. And from there, that's when you start to pull out the tools in the financial tool belt of retirement plan or investment strategy or tax saving tips and stuff like that. But that has to be built on a foundation of good cash flow, where you have a plan, you know where your money's going. Now you know how much you have to work with.
Yeah, I think we're gonna need to kind of dig deeper into that a little bit. But I had a question for you. So if someone wants to, let's say if you have a 9-to-5 job, usually, you have insurance, to cover your dental, medication and things like that.
Sure.
Like, is that something that you cover? Like, for people, like, say, some people quit their 9-to-5 job and they start working as freelancers, and like all of a sudden everything's on you, your retirement, your dental insurance, all this stuff. Do you have any tips? Hey, I know. You're on your own.
You are, and that's part of, if you're an employee and you're paid $70,000 or $80,000 a year, and then you can go be a freelancer and make 150, you think you just doubled your income, but you didn't, because the costs of being an employee are baked in for the employer. They're paying, if you're in the U.S., they're paying a portion of your taxes. They're paying in the form of payroll taxes. They're paying, probably for benefits like you're describing in retirement and all that stuff. Those are all costs that are pre-compensation to you. So like the whole total package of value and benefit you're getting from the employer is a lot more than your salary. If you have, even if you don't have benefits, just in the tax savings. But yeah. I don't personally do health insurance.
Okay.
I don't actually even sell insurance. That's kind of the fun part about me. I don't sell products. I don't make commissions. I do this strictly for a flat fee for my clients. So I have no other adverse incentives to try to make money on my clients, because they're the only ones paying me to do what I do for them. But I do have a really broad network of people that I know and trust in the space that I refer clients to. So whether it's a health insurance conversation or life insurance or dental or whatever, that's something that's a part of the planning process.
Yeah.
I would highly encourage. Man, that's another great one. Where it's like, don't try to do that yourself. I heard a really funny anecdote.
So who would you hire to help you with those kind of stuff?
There are brokers, just like if you wanted to get car insurance, you're not going to go
Okay.
shop
Yeah, just
around.
get a broker and yeah.
Yeah, and they're paid typically by the insurance companies. So it's not like they're going to charge you for talking. Whatever plan you pick, they're probably getting a commission on that, and that's kind of by design, right? So, but their job is to help you find the best. Yeah, so definitely go with a broker. Yeah, the world of health insurance is only getting more complicated.
No.
So don't try to do that yourself.
So what about retirement? How do you plan for your retirement? Do you just send an amount of money to the government to just keep it for you, or do you do your own investments on the side? What are your tips for planning for retirement?
I definitely don't recommend trusting the government with that.
Okay.
Or really much else. A healthy savings rate is usually 15% of whatever you're making. And the reason for that is, it would help if I had a visual to kind of illustrate this along with, but the reason for a 15% savings rate is if you save 15% of your income over the course of 30 years, you will accumulate enough to live on the income from what you've accumulated for an indefinite period of time.
15 or 50?
15, 1-5.
15%. Okay.
15%. So if you save 15 cents on the dollar and invest it, after usually about 30 years, you will have accumulated enough wealth to generate an income that matches the lifestyle that you're living and that you're saving the 15% on. Right? So if you make 100,000 and you save 15,000, after about 30 years of saving 15,000, you should have about 2.5 million saved, which will kick out $100,000 a year of what they call risk-free income. Nothing's truly risk-free, but just that's it's a math equation, right? Basically. So, how much do you need to save? Probably about 15%. Where do you save that? Well, it depends. You can save in a savings account, an investment account, a brokerage account. You could save in an IRA or a 401k. But as long as you're hitting that 15% savings mark, that's generally a safe number. Some people need more depending on life stage and current assets, right? If you're in your 50s or your 40s and you maybe don't have quite as long of a timeline that you don't want to work another 30 years, maybe a 25 or 30 or 40% savings rate makes sense for you to catch up kind of for the quote unquote lost time. If you're much younger and you've already got a substantial amount of assets accumulated, because let's say you hustled really hard in your 20s and now you're 31 and you've already got a good head start. 50% is still a safe number, but in certain cases you can back that down.
So do you recommend things like real estate investments and things like that, or
it depends?
That's a little risky?
No, so it depends. I mean, it depends on the person. Sam, I mean, investments are tools, right? And if you need a screwdriver, I'm not going to give you a hammer. So what tool you need requires a lot more conversation, to figure out when are you going to need the money? What's the money for? Going back to that every dollar has a job thing. So it's like, if you're saving this $15,000 a year on your $100,000 income, but you want to buy a house in 5 years or 3 years, and that's down payment money. Probably not going to recommend putting that in real estate, because real estate is locked up. You'd have to sell a property to get your money back. Or if you put it into some sort of a real estate investment fund where you're, invested in real estate in a pool of money where you can get your money back out a little bit easier, those types of investments kick off a lot of income, which is fine. But if you don't need that income, you're going to be taxed on it, and it's just going to raise your taxable income. It may make more sense for you to be invested in something that's more oriented toward long-term growth and very, very little income, so that you're not having what's called tax drag, which is where for the next 30 years you're paying little drip taxes throughout the year, or over the years, on income that you didn't actually need just yet. Even if it's reinvested, it's still taxable to you, or it still could be. Again, there's so much like, well, it depends. And so I'm trying to give clear answers to questions that have a lot of nuance. So just goes without saying, but none of this is like specific advice or investment advice. This is just general education. But I mean, there's a lot of nuance to these questions. Do you like real estate yourself?
Yeah, I love it. No, I'm not really like actively into it. I just love to buy a little rental property here and there, but yeah, it's not like I'm fully invested into it. I just feel like I think it's a good thing to do, because I mean, you can see how like properties gain value quickly. I mean, sometimes quickly, sometimes slower, but
Sure.
it's like, I don't know, can I call it like low risk kind of investment? I don't know if it's low risk,
It's
honestly, but
actually not, which is funny. It's
yeah,
actually considered higher risk.
is it? Wow.
It is because, and that's why the returns are higher,
Mm-hmm.
because typically higher risk, higher potential return.
Oh,
But
okay, I see. But
but the
like, yeah.
reason,
Mm-hmm, yeah, go ahead.
well, just the reason it's considered higher risk is because it can burn down,
True.
or it could, the foundation could crack, something that might not be covered by insurance.
Yeah.
If you have a renter, the renter could do, damage to it.
Mm-hmm.
The market could turn. Somebody could buy the lot right behind you and build a big development that plummets your property value. So over time, real estate generally returns like a 3 to 4% return.
Mm-hmm.
So
So compared to like stocks right now, like we are recording in 2025 April with all the tariffs stuff
yeah,
going on right now
great time.
in America. It's not just in America, actually.
Oh,
Everybody's
it's not
affected. So
everybody.
like, stock market, I have a friend who's like investing a lot in stocks. And the other day we were talking, it's like, oh my God, I just lost like 5K, like just like that. I'm like, okay. So for me, I'm scared of stocks.
Okay.
And when I was talking to him, I was like, for me, if let's say if you have a house or you have a property that you invested in, you may lose 5K, it may happen, but you're not gonna see it because you're not trying to sell. You have a
Sure.
stock, it goes down, you see it because you can see the numbers in real time. So that's what scares me mostly. Like when it comes to stocks versus real estate. Real estate, you lose money. Sometimes it happens. You're probably not gonna see it because it's all virtual, and then eventually it's gonna go up. You're not gonna see it until you want to sell or you see how the market is. But maybe you're right. It's actually high risk. Never thought about it actually that way.
Sam, what's funny is if you could see a ticker of the value of your rental property every
Mm-hmm.
day in real
Yeah.
time,
Yeah.
I wonder if you'd feel that it was as low risk or as
Yeah,
safe.
exactly. Yeah, yeah. That's a good
Because
point.
even
That's a
your
good
buddy
point.
who lost 5 grand, well, did he actually lose it or did the value go down and then it rebounded again? What, yesterday, day before?
Yeah, I
I
think
mean,
yesterday
yesterday
something happened.
there's a lot of market volatility right now. A couple things. So risk is, again, not to get too technical, but risk is defined as the likelihood of a permanent loss of capital. So if I put money into the market, into stocks, what is the likelihood that it's going to zero and never coming back? That is risk. Volatility is the fluctuation in that value over time. So it's up today, down tomorrow, up next week, down the next month, up the next year. That's volatility. And the swing of the roller coaster is determined by the type of investment you use. Again, going back to the tool analogy, you've got hammers, nails, screwdrivers, saws, depending on what you need the money for. A saw will do a lot quicker damage, a lot more production than a hammer, right? But sometimes you need a hammer and there's nothing that can substitute for it. So trying that analogy back to money, like you've got bonds, you've got real estate, you've got international equities, you've got your own national stocks or equities, US markets or whatever. But even within the equity markets, you have small companies, medium-sized companies, big companies, and then you've got companies that are stable and just like dividend paying, like, think of like a Home Depot, right? Something that's been around a really long time, very stable, predictable cash
Yeah.
flows,
Yeah.
compared to something like an Nvidia that in the last 5 years has just, you know, huge changes and fluctuations. So even within the world of equities, of stock investments, there's a lot of nuance and a lot of, well, it depends on what your objective is and when you need the money.
Yeah.
Generally speaking, every 5 to 7 years is what's called a business cycle. And pretty much, I think over, again, this is just education, just data, but like I think over the last, I don't know, 100 years of data, for any 7 or 10 year time period, the stock market has only ever returned a negative return in, like, I mean, gosh, maybe 3 or 4 out of the 100 periods. So it's very, very rare that over a long 7 or 10 year business cycle period, you actually get a negative return. Generally speaking, since the inception of the public stock markets, the growth is up and to the right. Now, it's not 25% a year. The average is somewhere around 6.5, which is even less than a lot of people might guess. They might think
Yeah.
like, oh, it's, I don't know, 10%. No, it's actually not that high.
Yeah.
But over time, equity markets do perform pretty consistently. They have performed well. And so if you have enough time to wait it out and to play the long game with your savings, you are, ironically, it's safer to go into the market where there's sustained historical growth than it is to just hold the money in your mattress where inflation
Yeah.
will erode the value of it every single day. I heard a really
Nice.
great, there's a great video out there, and there's an old investor guru who once said, pay attention to the owner, not the dog. All right. And so it goes with this story of a dog owner walking their dog in Manhattan going from one side of the park to the other. And as they're walking, this dog is on a pretty long leash, and it's this small little super energetic dog that is just darting everywhere, running around, like sniffing stuff, jumping up on benches, like running forward, backward, all around in circles. And the owner is totally unfazed, just slowly walking steadily to the destination.
Yeah.
Well, the dog represents the daily changes in the stock market, right?
Yeah.
It's all over the place. But the owner is that slow, small, consistent growth over time.
Yeah.
And so anytime you zoom out and look at charts of the equity markets, it's very reassuring, especially in times of tumult like we're in right now.
Yeah. No, I agree with you 100%. Everything's gotta be kind of long-term planning.
Okay, so I want to throw a question your way.
Sure. Yeah. Go for it.
Going back to this whole like content creator audience, because I've been pretty dry in finance for a few minutes now. What if your money could tell the same story as your content?
Come again?
What if your money, your investment choices could tell the same story as your content?
How?
So like I said, I help Christian business owners, especially, and I'd help any business owner, but I most align with Christian business owners who want
I'm
to
Christian,
align.
by the way. So,
Oh, awesome. Sweet.
Yeah.
And so I help those folks who want to align their financial lives, their business with the principles found in Scripture. I believe God has laid out the most brilliant and beautiful plan for living a well and healthy, flourishing life His way, and aligning your investments with Christian and biblical principles will promote a world that flourishes, will promote the best for the common good and the best for human flourishing. So I believe fundamentally that investing is ownership and that ownership is responsibility. And so I actually approach investing quite differently than the typical advisor, the typical financial expert out there. I believe that investing is an opportunity to push capital toward businesses that are doing good in the world, that are promoting the common good, promoting good products and services, taking good care of their employees, dealing honestly, creating services or products that are good for the world, good for the environment, that are not doing harm, that are not profiting on addiction or bad things generally, right? Whether it's, gambling or adult entertainment or abortion, or by investing in a way that pushes capital away from businesses doing bad things and toward businesses doing good things, we are helping to create the world that we want to live in. And I believe fundamentally that the right thing and the good thing and the smart thing are the same, especially when it comes to investment decisions. So going back to the content question, if you're a content creator, especially if you're a faith-based content creator, or even just someone who likes to tell good stories and likes to promote the beautiful things in the world and what you do, and deliver excellence with your creativity, there is a way to do that even into your investment decisions. It doesn't all have to be well, not to say anything against it, but it's a way of aligning your your money decisions with what you hold most deeply and with what most deeply defines who you are and what you value most.
Yeah, that makes sense. 100%. I agree with you 100%. Yeah, I think we should be a little more intentional when investing. Well, I'm assuming it's okay, but if you invest in things like Apple or Nvidia, like you were saying, they're not really they're like neutral. They're not doing anything bad. Maybe they are. We don't know. But they're not doing anything. iPhones are good. Technology is good.
Sure.
Do you intentionally look for companies that are doing some good work? Because most companies, I would say they're just neutral. Obviously, if you want to invest in something like, cannabis and things like that, they probably, drug companies that, they would do bad stuff to the society in general, that you can tell. But most companies are actually just neutral, like YouTube, Facebook, Apple. How do you define those neutral companies?
Yeah, well, that's a great question.
From a Christian perspective.
So you started, I guess, assuming or asserting that those companies are neutral. I wonder if you'd be surprised to know more about how they actually operate and how they make profits and what they do with the profits that they make.
Yeah, you're right. Sorry.
Social media is a great example. Social media actually profits the most on addiction because they are vying for more and more of our time on their platforms. Now, social media has some phenomenal uses, no doubt about it. Networking, keeping up with
Yeah.
friends, connecting with people, right?
Mm-hmm.
It really can be a beautiful, beautiful tool.
Yeah, and
But
most
if they're
crucially.
deriving profits from our addiction to their platforms
Mm-hmm.
and from the dopamine release every time we get a notification that somebody commented or liked or followed or something, and they structure those notifications and time delay them in order to maximize platform engagement, that is not ethical. And it's not good for the developing brain. It's not good for the developed brain.
Yeah.
So I would argue that when you start to dig into the operations of how the business is going about making its profit, you may find a lot that you don't like. I mean, another great example is so I have 4 kids, we're about to have number 5. My heart for family and for kids is enormous. I think abortion is an absolute tragedy, and I'm not ashamed to say it. I can't fathom owning stock in a company that creates drugs to administer abortions and then Amazon delivering them next day to your doorstep. Johnson & Johnson makes abortifacients. Well, Johnson & Johnson also makes cleaning products, and they make baby wipes, and they make hundreds and hundreds of other phenomenal products that are good for the world. But a lot of their profit comes from things that I cannot allow to fund my savings. And when you think of investing as owning something, you are then profiting from all of the operations of that business. So
Yeah.
a great counter argument here I hear a lot is, well, Nick, come on. I mean, if I walk into the convenience store to buy a gallon of milk, I'm walking past adult magazines and lotto tickets and tobacco and alcohol just to get my jug of milk. Can I not go to the convenience store anymore? It's like, well, you can actually, and here's why: because there's a difference between ownership and patronage. So when you go to the convenience store and walk past all of that stuff that you don't want, and you get the milk out of the fridge, and then you go and you put gas in your car and you go home, what you're saying, you're voting with your dollars to the owner to say, all of this shelf space that you filled with stuff that I'm not buying is costing you money because it's shelf real estate that you're losing money on.
Yeah.
I'm here for milk and gas. That's what I'm buying and I'm leaving. But if you own stock or if you own the convenience store, you're now profiting from all of that, right? The gambling, the addiction, the alcohol, the tobacco, the adult, all of that is now funding your profits. And so by owning it, you now have participation in that production, that distribution, that advocacy for those things you're against. Now, to be clear, I'm not doing the screening myself. There's a couple different companies that do this full time
Okay.
with a team of experts and brilliant people, and they put out reports and they create some investment products and portfolios that I use for my clients. But I carefully vet what they do and monitor and read up and keep track of how they're going about the process. But they do great work. I highly, highly recommend them and use them for my own clients.
Yeah, I mean that was gonna be my next question. Like I was like, how deep are you willing to
Yeah.
go? Like,
How much time do you
because it's
have,
gonna
Nick?
be a
My
lot of
gosh.
work, man. Like, first of all, you have to worry about your money because you need to make profit.
Yeah.
Second, you have to worry about like what do they do? What, like, oh my god.
Exactly. Well, so to make it simple, like just to bring it back down, I mean, if you're good, I think we should each focus on what we do best to make money. Right. So if you're really good at content creation, fantastic. Hire this stuff out to a professional.
True. True. Yeah, you're
Bring
right.
somebody on board who can help you keep an eye on your business and personal financial situation and make sure that you're tracking and trending in the right direction, that you're heading where you want to go, and that you have a plan that you're actually executing on. So you have a goal, right? Because if I told you, hey, to get where you want to go, you need to make an extra $5,000 a month, I bet you'd really work toward that, right? And you'd find a way to make that happen. But if you're sitting there like, scratching your head, overwhelmed, like I don't even know where to start, exhale. I don't do video production, right? I don't work on my own car. I don't even do my own taxes. I I try to stay in my lane of doing what makes the most, money for me and is most profitable for me to do. And then, like you said, bringing in other people, right? Just like you'd bring in an editor, just like you'd bring in a VA for scheduling and for contact management. Bring in a third party to help with your personal financial planning.
Yeah, that's really good, man. So going back to cash flow management and tax saving, I wanted to ask you because we talked about 15% on investment for retirement and kind of future. Like, what's next after that? Like, what's the percentage for? Obviously, can be the exact percentage number, but like for things like, because I know most people want to buy more gear, especially videographers, because you could write it off. Is that
True.
a thing? Do you
True.
think? Because again, like think about it. You buy a new camera, new gear, and you maybe you hire more people, obviously, and that's going towards growing your business because you have better equipment and all that. Life is better and easier, but that's also money gone. But you can write it off for your taxes. So like, what's your advice on that?
Yeah. Okay. So this is a lot more subjective. So I can be a lot more specific here. My general rule of thumb is if you're making less than 250 a year, you should be taking home at least half of that, at least, probably more, probably 60 to 65%, and you get to run your business on the rest. And the reason that I say that, because you might hear that and think, but wait, if I'm making 200 and I take home 100, now I'm paying taxes on the 100. Yes, you are. Taxes, and we can pull some different levers and use some other tools, right? Like we talked about earlier, to maybe defer that income into the future, save it through a retirement plan, an IRA, a 401k, that kind of thing. Taxes are not, we should not strive to avoid taxes at all costs. Okay. Anybody that recommends, oh, you should go, spend that money on gear, buy a new camera, buy something so you don't have to pay taxes. Have you ever heard, like, don't let the tail wag the dog?
Mm-hmm.
That's totally letting the tax tail wag the profit dog.
Mm-hmm.
Spending money to save 20% on it, 25, 30%, may not always be the best decision. Now, if you have
Yeah.
a valid business expense and you're saving toward it and you just decide, hey, I'm going to take a little less income this year to do this important thing for the business, sure, totally get it. But as a rule, you got into business to be profitable.
Yeah.
Don't steal from yourself. Entrepreneurs are so bad about that.
Mm-hmm.
And the cycle doesn't end either. So that's why I highly recommend get disciplined with your cash flow and then stick to it. So you want to buy a new piece of gear, great. Well, if you're making 200 and taking home 100, you have 100 to run the business. But if the piece of gear is 30 grand and you need, 85 to run your business, now you have 15. Well, that means you need to save up or cut an expense somewhere else to make up that shortfall, because you have 15 now of extra money in the business to do something with, but you need another 15. So do you finance it, and can you support the payments? I don't usually recommend that, but it can depend. Do you cut another expense somewhere? Do you sell a piece of gear you're not using as much, right? So always be finding a way to, because this triggers a couple things in the brain, Sam. So like when you limit yourself, like I'm describing, it triggers, I don't want to call it a scarcity mentality, because that's usually detrimental, but it triggers the creative process that helps you find different solutions to problems that
Yeah.
that you weren't problems 5 minutes ago. You made it a problem by sticking to your plan, because you have the money, right? Technically, you have that other 100
Yeah.
that you're paying yourself, but you don't. That's now out of the picture. So now you've only
Yeah.
got 15 grand to buy this 30 grand piece of gear. What do you do? Well, now you're
Yeah.
going to get creative. Now you're going to make that
Yeah.
extra phone call of, hey, do you still need such and such job? I'd love to do it for you. And now you're building the business through additional work and additional labor and additional creativity, rather than just, oh, I'll just buy it because I have the money.
But
So,
so yeah, go ahead.
well, it's the same principle that, like, if you want to lose weight, use a smaller plate because you can't fit as much food on it. This crazy study, it found like the average plate size in America is like 10% or 50% larger than in other countries, and how it's contributing to obesity, because when there's a bigger plate, you can put more food on it, and
Yeah.
it feels empty if it's not full. So by limiting your plate size with your finances, you get more creative.
So when you spend, let's say you're making 200 grand a year, and then your profit is 100,000, you get taxed on 100,000. Is that correct? Or you get taxed on the overall revenue?
Okay, great question. So you get taxed on whatever's left over after you've done your business expenses, typically. Now, I'm not a tax professional again, so I have to. Compliance requires me to say that little disclaimer, like, this isn't tax advice. I'm not a tax pro. I'm not giving you tax advice. But generally speaking, in a business, if you make 200 and 100 went to operations of the business, marketing and software and gear and rentals and whatever else, those are all business expenses. They reduce your taxable, they reduce your total income down to your taxable income. The 100 grand that's left over in your business, in most cases, will just pass directly to you on the tax forms, and then you'll pay taxes on the 100.
So, which means if you spend an extra 30K on a camera, well, that would be like, I don't know, what kind of camera that costs 30K, but yeah, that means that goes towards your expenses. You're not paying tax on it, but you also reducing your profit.
Exactly.
That's where it becomes a little complicated.
So you're spending 30, now you're taking home 70.
Yeah.
You just took a 30% pay cut to buy the piece of gear.
But there's also yeah, go ahead.
Well, can you turn around and make that back with it? Like, is it really gonna increase your revenue or make you that much more profit? Like, next year, will you make 130? Will you get it back? What's the justification for? I mean, just would you hire someone for 30 grand to come and wash the windows? Well, no, like, that's not a critical business operation.
Yeah.
Well, okay, let's treat every piece of gear like a critical business component, and every single piece of gear needs to be making you money. And if it's not, you need to sell it and get your money back out of it so you can buy something that is going to make you money.
If it's something that it's probably going to help you make more money next year, then it's 100% worth it.
Sure. I mean, if you're buying a piece of technology that's going to speed up your workflow, that's going to make you more efficient, that's going to, something that will improve your productivity by a measurable amount, right? If you know that it's going to save you 3 hours of editing time every week, like, sure. Then we can define the hard value of, well, 3 hours of your time is worth this times this many weeks. It'll take this long to get your money back, quote unquote, out of that piece of gear. But yeah, everything in your arsenal has to have a reason for being there. It's so easy to fall for the shiny toy temptation, isn't it, though?
Of course. Of course, man. So let's talk about your space, like your home office versus having maybe a commercial place. I know personally I work from a basement. I just find it's easier. Everything I do is online. I can do my meetings. I can help my clients from my basement, so I don't need to get a commercial place. And I can also have a family, so my kids could be in the next room, so if they need me, they have access to me, which is really cool. But tax wise, business expense wise, because I know some people, some tax professionals will tell you to write off your house if you're working from your home and things like that, or part of your house, not the entire house. So
Sure.
what's your advice? Any tips on what's best, other than having your family close to you, tax wise?
Honestly, the advice I have here is not really tax based. I would recommend talk to your tax pro. If you don't have one, I can help you find one. Or you can Google and find one near you. But find a tax professional in your region, right, especially in your country, and ask them that question, because different countries have different rules and requirements. And honestly, the tax savings of working at home versus an office is pretty negligible. I would argue this is more of a profitability question and a revenue question. What is going to help drive your revenue, drive your profitability the best? Are you better if you lock yourself away for 6 hours out of reach of your family? Can you get more done more efficiently in 6 hours than you could at 10 hours at sitting in your basement? Because that's a much better use of your time.
Yeah.
Is it better for you mentally to have a drive to work and a drive home from work, to meet clients away from your house? Is it better for you to have an office space where you can store everything so it's not stressing out your wife that your basement is full of all your stuff, right? So I think that's a much softer question that has more to do with your personal life preferences and how you work best.
Yeah.
And the only way to figure that out is through practice and iteration.
Yeah, I think that's legit.
Yeah, if you're considering an office, try it, right? Try it for a month. You can do anything for a month.
Yeah.
See if you're more productive. See if you can work a 6 hour day or a 4 hour day instead of an 8 or 10 hour day and be just as productive.
So what are the mistakes that you see? Because you've been working with a lot of clients, obviously helping them with cash flow management and their financial planning for their businesses, what are the mistakes that you see most entrepreneurs make when it comes to financial planning?
I hate to say it, but probably not bringing in an expert soon enough. And I'm guilty of this myself. So, I can't point a finger at anybody without first telling my
How
own
soon
story.
should it
So,
be?
if you're in business already, you should have talked to someone by now. And it's not expensive. It's not, or it shouldn't be. It's not usually very expensive to just have a free conversation with someone. Even if you have to pay a few $1,000s for a one-time consult or an audit or a tax plan or something, at least that way you're working with a professional who can help you get set up and get things done the right way. So here's an example. This is pretty easy to happen. In the States here, you have to, you don't have to, but if you file to open an LLC, you have to maintain that registration every year. You also probably need a business license within your city or county, possibly both. Those are licenses and registrations that have to be maintained every year. If you forget, they will dissolve your entity. And if they dissolve your entity, it's just administrative headache, and you could get in some other bigger headaches from that. I should probably drive that home a little bit more. If you were working with a professional who is checking on that for you every year, just as a normal course of operations, they would catch that and make sure that didn't happen. That's going back to that risk management protection thing we were talking about with the entities, and like making sure that if you get sued in your
Yeah.
business, it's not going to torpedo your whole life.
Yeah.
If your entity is dissolved, guess what? There's no protection. You can say you have an LLC, but if you didn't renew it, you don't. You didn't
Yeah.
for that time period. So the embarrassing part is I do this for a living, and that happened to me. That's how easy it is for this to happen. Another issue I see a lot, so much, is people thinking that if they just run their business like a personal expense account, that's somehow more efficient or more tax savvy, or it'll save them more money. In reality, it's messy, and it's typically inefficient, and it leads to overspending. As you're making money as an entrepreneur, it's so hard to control your spending. 'Cause you're like, well, I'm making money. I can buy this stuff and do these things with it. That's why, going back to that rule of, if you're making less than 250, you should be taking home half of it. So before you think that you can run your business on your revenue, think again, cut it in half, and now try to run your business on it to make sure that you're taking care of yourself first and not stealing from yourself. So mingling personal and business together, silly administrative things that as a creative or even just as a service provider we'd never think of because we don't know the ins and outs of the system. Those are some common mistakes that I see.
Good points right there. So I wanted to ask you, because most of us, mostly like video entrepreneurs or photographers, creatives in general, we have this thing where we kind of like get into business by accident. We start off as just as a hobby, and then, you're playing with the camera, and then all of a sudden, oh, by the way, you can make money. Somebody calls you to shoot a wedding. Maybe it's a cousin. You do it. He give you $500. Next thing you know, right? You're like, oh, maybe if I buy a better lens and a better camera, I could charge a little more. And next thing you know, you're charging $1,000. And then fast forward 2 years, you're in business. You're making maybe, I don't know, 30K a year, and then keep growing. You learn a little bit of marketing here and there. And you scale your business to something like, okay, 100K, 50, 70, 100K. And then, oops, you are now a video entrepreneur and you're making money and you have a business. So,
Such a
and
common
that,
story.
that becomes like, it's kind of messy in a way. Like, when do you know that you actually have a business? The whole thing is just like you're trying things and things are happening and money's coming in, and all of a sudden you have a business. Like, what would be your advice to someone who's probably just doing videography as a hobby and making a little bit of money here and there? Like, they still have their 9 to 5 job. Like, what would be your advice to that person?
Slow down.
Slow down.
Don't get ahead of yourself. There's nothing wrong with a hobby side hustle and a 9 to 5. And the hustle culture, everything faster, farther, higher and to the right, bigger is better culture we live in is built on a foundation of lies. I mean, it's just not true. Bigger is not always better. Faster is not always farther. So take your time. And if you really get good enough that you can't turn down the business and the business comes to you and you love to do it and it's more fun to you and that's all you think about, then you can consider making a plan, right? To really take it full time and leave your normal job. That may be 3 months. That may be all it takes, right? It may be that in 3 months' time you get better, people are paying you, you're excited, you want to do this, and you have an opportunity to leave. It could be 3 years. So I'd say slow down, take your time. I think that's where so many of us get really in trouble, Sam, myself included, is we put on ourselves this pressure of performance and execution on our own timeline, and we think we're already behind. We have to catch up, and to catch up, we have to do more. And to do more, we have to just the hamster wheel and the anxiety of production and more and better, and it starts to spin up. And ultimately, it's it's pretty it's an all-consuming monster, right? That's never satisfied. It never says enough, and it's not healthy. And that's not when you're going to operate your best, especially in a creative place. Like writer's block is a real thing. So if you're in a creative space and you find that the creativity is just gone because your zest for life is kind of gone because you're burned out because you did it too fast, because you didn't, et cetera, et cetera. So like that, you don't want to be there. So maybe where you are might be a better position than you realize for now. I don't know. How does that hit you? I mean, it sounds like that was kind of your story, right? The $500 cousin's wedding.
Oh yeah, I mean, most of us, man, like most people that I know, most videographers and photographers that I know, that's how they started. Now I know some people who knew that's what they wanted to do, but still they started like just playing with the camera, like how you did. It's addictive a little bit. When you do it, you feel addicted, and it's fulfilling, being able to create something out of nothing. And then eventually you start making money, and then you're like, okay, anyways, I don't even like my 9 to 5. So why not do it? I will not do this full time. So yeah, but it's challenging because most people some of the things that you mentioned, like when you start doing this, you don't know the tax paying side of it. You don't know that you kind of have to rely on yourself when it comes to retirement, savings, all the things that you're getting, benefits you were getting from your 9 to 5. So yeah, and then some other skills I have to learn, including marketing, and it's a lot, man. It's a lot.
It is a lot. Oh, it is a lot. Yep.
So when you say slow down, man, it makes a lot of sense. So yeah, at some point we're gonna have to land the plane. But I wanted to ask you, like, do you have any last words for most creatives, entrepreneurs, when it comes to financial planning before we end this episode?
Yeah, if I could kind of summarize like our whole conversation, I'd say there's like 4 or 5 points. Your business can't thrive if your finances are a mystery. Profits are how your business takes care of you. Freedom comes from structure, not just from hustle. We kind of touched on retirement, but a lot of people, especially when we're young, we're like, oh, I'll never retire. Retirement's not quitting. Retirement is choosing work that you love and the freedom and flexibility and time freedom to do that, not being bound to having to earn a paycheck. And then, kind of looping back on that investment conversation, your investments and how you're investing your money can and should tell the same story that you live to tell in your work.
Yo, Nick, man, I do appreciate you a lot for being our guest today.
It's been my pleasure. Thank you for having me.
Absolutely, man. So if you have a minute for people who would want to connect with you, what's the best way to get in touch with you? And also, is there any specific ways that you would be able to help people if they to reach out to you?
Yeah, absolutely. So most of my engagements with clients start with just a quick chat to see if there's a good fit where I could actually help someone. Like I said, I'm not here to sell stuff. I'm not here to sell people. I'm here to help. And if I can't help you, I have no problem referring you to someone who can. So if anybody has been listening to this and wants to talk more, you can find me, Nick, at openhandedwealth.com. You can go to my website, openhandedwealth.com. I do have a special section for your listeners to be able to check out some free resources around these topics we've talked about today. My website, openhandedwealth.com/freebies. And there's just a handful of guides, a couple of videos there that they can watch and kind of get a feel for my approach, some notes on what we've talked about today, as well as some real tangible like templates and guides to be able to put into practice some of these ideas.
Do appreciate you, man, a lot. Guys, again, we're going to leave some of his contact info in the show notes that you're watching on video on YouTube or listening on the audio version of this podcast. Other than that, guys, on my last episode, we had a guest who actually we talked about how to make your first $10K a month. So obviously, if we have to plan for our financials and everything, we need to make the money first so we can have those plans, right? So if you
Solve
want to
one
know how
problem
you,
before you create the next, right?
exactly. So if you want to know how to make that first 10K, if you haven't hit that first 10K month yet, you want to make sure I'm going to link, if you're watching on video, I'm going to link the video, the episode right here. If you are listening on audio, obviously I'm going to leave it in the show notes. But other than that, thank you, man. And Nick, I do appreciate you. And guys, we'll see you next time.
Thanks so much for having me, Sam. It's a pleasure.
Thank you, man.